Hi traders, welcome to Market Outlook Trends, Risk Events and Trade Setups, brought to you by Vantage Markets. This is a weekly webinar where we focus on what's been happening in markets and what is about to happen in the week ahead. Whilst I'll just let you have a quick look at the disclaimer, I'll just run through what we hope to get through in the next 30 minutes or so. We'll follow the normal format, so we'll just check out how markets are trading currently. We'll then look at a couple of key stories from this week, last week actually, and today as well. Just some themes and highlight some of those, what we're looking at essentially, before then looking at stock markets and the charts on the major US indices. We'll then go through to look at last week's main events, including the UK budget and any effects on sterling, of course. We'll look at the RBNZ, that rate cut there, and the effects on Kiwi dollar, as well as some CPI data last week from Australia and Japan. So we'll look at the Aussie dollar and dollar yen as well. And then we'll just do a quick preview of this week's main events. You can see it all here, actually, although we won't be looking at NVIDIA's results. So that should have come off. Apologies. But we'll look at, preview of last week's main events, and yes, a run through of some of the US data and also Eurozone CPI data and Canadian jobs as well that we get this week. If you just bear with me 1 second, I just need to just correct something. So bear with me 1 second. Right, apologies about that. So here we go. So first up, let's just check out how markets are trading currently. I should say as well, if you do have any questions, please do ask them along the way, and we'll be more than happy to answer those. Whatever I'm talking about, or whatever you're looking at, or any trade setups, please do ask any questions in the box, and I'll try and answer those as best I can. Markets currently then, Asian stocks, they began the new month pretty mixed actually, with market participants pretty cautious. So they digested weak Chinese PMI data. Sterling against the dollar, cable has been in focus, of course, after last week's budget, and is pretty choppy, although the dollar is seeing some weakness. And we get to that really on yen strength, actually, and that's pushing the dollar index down. And seeing cable just marginally higher, but it does remain choppy, as we have had UK PM Starmer's speech where he outlined the growth mission that the government are on, really, and defending as well the budget after Chancellor Reeves was forced to deny lying to the public about UK finances. That happened over the weekend in the UK. Otherwise, crude futures were underpinned really and supported from the open following the OPEC Plus decision to maintain output plans throughout the first quarter of next year. We also had some focus on US and Ukraine negotiations on Sunday, focused where the de facto border with Russia would be drawn under a peace deal, while the 5 hour meeting was said to be pretty difficult and intense, but also productive. That's according to two Ukrainian officials cited by Axios. We'll get to that as well. Otherwise, European equities are a touch lower, really. Eurostoxx 50 was down 0.4%. A few moments ago, I think, after the cash market closed, with gains of 0.3% on Friday. Just before I get to stocks, just a few interesting stories then from this weekend. Last week, that yen move is interesting and quite a surprising move, really. If we look at dollar yen quickly, let me just show you this. Which is here, so you can see, just blow this up. You can see this down move, down 0.64% now. After a couple of days of consolidation, really. Let's just take the count the channels off. You can see that high with lots of speculation about intervention. That high was at 157.89. But as I say, a rather surprising move this morning, really, by Bank of Japan Governor Ueda. He sent a clear hawkish signal in a speech this morning, as I say, causing a jump in market pricing for a December rate hike by the BOJ. That's gone from sort of 14 basis points to 21 basis points now. So 84% chance really of a rate hike. Aside from explicitly saying the Bank of Japan is considering the pros and cons of a hike, Ueda hinted that there is no clear opposition by new Prime Minister Sanai Takaichi to raising rates. Of course, she is known as a policy dove, and we've had lots of speculation about possible interference by the government with or towards the Bank of Japan raising rates. But Ueda has explicitly said there's no clear opposition from Takaichi. And also, then a second factor had been crucial for markets. That was actually, and whose basic understanding was that Takaichi, as I said, was a dovish leaning influence. That has sort of been kiboshed, if you like, by Ueda, and we've seen pretty strong yen strength this morning. So an interesting signal there ahead of their meeting in a couple of weeks' time. That's the Bank of Japan meeting. Otherwise, last week, really interesting. We got, reports from Bloomberg citing sources that White House National Economic Council Director Kevin Hassett was reportedly seen or is reportedly seen as the frontrunner in the Fed chair search. Although then separate sources actually said there is no front runner. Interesting, we had a sort of short list of 5 candidates. We were down to really Hassett, of course, Waller, Bowman, Walsh, and Ryder. Hassett is seen probably as the most dovish profile amongst those. He kind of advocates aggressive rate cuts, prioritizing growth of inflation control. The bar as well to reverting to QE under his watch is probably lowest as he aligns most closely with President Trump's agenda. I should say, though, that he has nevertheless stressed the importance of a fully independent central bank. So, yeah, that's probably why we have seen, and we'll look at the dollar shortly, but just quickly, we just had run into some resistance. We put it out on our dailies quite often. This resistance from late July, early August, and then also early November. And we've run into the 200-day moving average as well, the black line, and now we're just moving down below that. So that resistance pretty strong around sort of 127 on the dollar index. And we're moving down below the 200-day moving average. That 200 days at 99.66. These dotted lines in here you can see is a long-term low from July 2023, 99.57, and then also a fib level of this move lower this year that we've seen, minor fib level at 99.51 there as well. So decent resistance around these two areas really, and we're just moving lower now. The blue line, a 50-day moving average, that's at 99.04. Yeah, so just watch this into obviously more data now that we're getting, but also this Kevin Hassett front runner story that is saying he's very much a dove. Rate cuts on the horizon then, or more rate cuts potentially if he is confirmed, and that could be before or in the next couple of weeks by all accounts. And that would be a signal for markets and may put pressure on the dollar. I mentioned Ukraine, of course, negotiations on the peace deal they had somewhat stalled, actually, but Special Envoy Witkoff's trip to Russia this week is in focus, as that does have some potential of leading to a breakthrough. Given how cautiously markets have been trading, of course, on the prospect of a truce, you kind of think any meaningful progress should be or should lift really European high beta currencies and possibly weigh on oil and gas prices. Remember that given the high sensitivity of the euro's medium-term fair value to energy prices, the implications for euro dollar then extend beyond the sort of initial impact. So that's just some thoughts on that. And the Ukraine peace deal potentially happening, or news of that if we do get something, the impact on the euro for sure, and also those, as I said, high beta other European currencies. Just moving away from those stories then to equities. Let me just grab a couple of charts that I've got. First up, Alphabet has obviously been in the news a lot over the last couple of weeks, at least. AI spotlight really shining on them with Google's parent stock now probably the 2025 standout performer against the Mag's 7 peers. You can see that here, comfortably outperforming Nvidia, Microsoft, and the other Mag 7s, with Tesla there down at the bottom. This is rebased to 100 from this year, and you can just see how it's really taken off in the last few weeks or so. Alphabet, that is. Basically, once seen, of course, on the AI back foot, we have to remember that following OpenAI's launch of ChatGPT, Alphabet really has benefited from the strong performance of its cloud business, and then the launch of the latest version of its AI model, Gemini 3. Meta as well. Then we have that news there, reportedly in talks to spend billions of dollars on Google's chips. That news was last week and rattled really Nvidia as well, which had a terrible month last month, all in. But Alphabet shares continue, as I said, to go higher. They're nearly up now 70% year to date, and that's roughly doubling Nvidia's 2025 gain. Really interesting that. And it very closely got to a $4 trillion market cap value. Google, that is. I think it's now, or Alphabet now down around, well, 3.85, I think, or so. And Nvidia just above 4 trillion, 4.2, I think. Obviously, there's concerns about returns on massive AI investments. They've weighed on tech shares generally. And of course, potentially that will remain an issue for markets in the coming weeks, even as stocks, of course, very close now to record highs, rebounded quite nicely from that recent pullback. Okay, that's Nvidia and Alphabet, really. Just some thoughts on that. And also, quite like this chart from Reuters that they put out, matrix that you can see with performances through the months, seasonality. Then this is what we're looking at here through the different years, going back 10 years, of course. Red being down, obviously blue, dark blue being very strongly up, and you can just see obviously only a few down months this year, of course, going into December. And then we look at November and December along the bottom here. Generally, you can see very few times, only, well, 3 times when November has been in the red. But if it is in the blue, then generally, sorry, even if it is in the red, actually, if you look, you can see generally we outperform or we're positive in December. That is really what that is saying. So we were down a small amount in November on the S&P 500. We've only been down once really in 10 years, and we were still positive there. Otherwise, yeah, just some seasonality figures for you going into the last month of the year. If we look at a couple of charts then, just to show you how close we are to these record highs. Sorry, just trying to get the chart up. A couple of technical problems. Sorry. So yeah, here's the chart that you can see. Sorry, just bear with me. Yeah, this is the S&P 500. You can just see then the dip down and then pretty decent buying on Friday. Actually, yeah, stocks extended their gains. That gave us a 5 consecutive win streak, basically, leaving the week more than 3% higher in the S&P. Once again, the kind of pattern is clear, really. In an environment with broadly supportive macro fundamentals, it rarely pays actually to chase weakness. And equity drawdowns, really, they tend to stall around the 5. As expected, then cyclicals they outperformed defensive last week by around 2%, although on a 1 to 3 month horizon, basis. Defensives are still ahead, and that's really thanks to the exceptionally strong run we've seen in healthcare and some of the giant stocks like Eli Lilly, which obviously hit a $1 trillion market cap value not so long ago. Investor sentiment then that also turned quickly last week, really. And the VIX, we highlighted that last week actually, and in our week ahead commentary that it dropped from sort of 26 down to 20 down to 16, and now we're up at 18, long-term average around 17. So that really pushes us back into the sort of complacency zone, if you like. But then, given the macro backdrop, really low implied volatility, sorry, is not really that unusual. So the Dow that was up 0.6% on Friday, S&P 0.5, Nasdaq 0.7. We just bounced with 5 straight days, really, through the 50-day moving average. That's at 67.24, and then the all-time high now is at 69.20. So we're just 70 points away. So not a great deal. 1% or so. Although futures are lower, pointing to a lower open to kick off this week and this month. On the Nasdaq, similar bounce. You can see through the 50-day, that's at 25,016, and the all-time high is at 26,182 there. Again, though, Nasdaq futures pretty low, actually down 0.8%. Pointing to yeah, pretty low open. The Dow after 5 consecutive days as well. That's at 47,716, a record high at 48,431. Then the 50-day moving average is at 46,753. Okay. Let's move on then to last week's main events, and they were well. We had some US data first of all. Retail sales growth slowed in September, with sales increasing by a modest 0.2% month on month. You can see here the expectations were at zero point 0.3 core and the headline at zero point 0.4. So the headline printed at 0.2%. We also got pretty modest consumer confidence index data, actually. That saw a decline in November to 88.7 from 95.5. Worth pointing that out because it was the second lowest reading in 5 years. That's consumer confidence. And really, the most recent activity data, plus that data as well from the US, adds sort of fuel to the fire of possible worries surrounding the US economy. And markets really currently pricing in around that sort of 85% plus chance of an interest rate cut. I said earlier about sort of macro fundamentals being broadly supported, but that then is supporting a rate cut, which is then helping risk assets as well. So that's US retail sales. Moving on to the budget then in the UK, and we'll look at sterling against the dollar shortly. But in summary, well, the autumn budget, a lot of gossip and speculation, as we said, especially in the UK. If you're in the UK here, and really that budget delivered kind of short-term stability, but didn't really fix the bigger long-term problems. So, yeah, in summary, the Chancellor, she announced 26 billion in tax rises, mostly delayed until 2028 to 2029, which wasn't really what the market was looking for long term. But it did boost then the government's fiscal buffer, if you've been following this, from sort of 9.9 billion to 22 billion. And that was pleasing for markets more broadly. That covered higher welfare spending and really kept her rule intact that everyday public spending must be funded by tax revenues by 2030. Overall, though, the budget did lack sort of major reforms needed to lift the productivity problem in the UK, competitiveness, and also long-term public finances. Interestingly, OBR, so that's the Office of Budget Responsibility, they are an independent body, supposedly. They saw, or they cut the UK growth forecast from 1.8 to 1.5%. And debt is expected to stay around 95 to 96% of GDP for the rest of the decade. So not great numbers there. The market then, if we just pull up cable as well, so bear with me 1 second. The market reacted fairly positively, as I said. Let's just grab cable. which is here. Yeah, pretty positive on the market side, really, at least for now. No major sell-off in sterling, no major sell-off in UK assets, really. And despite some early jitters, actually, they held up pretty well. Um, Gilt yields they fell across the curve, and that suggests a slightly more dovish tone. Obviously, the worry was that gilt yields would jump and then sterling would sell off if the markets didn't like what the chancellor said. That wasn't the case. Yeah, slight falling in yields, which sort of denotes a dovish tone. But sterling strengthened, really helped by, well, that higher than expected fiscal headroom, as I said, fewer near-term tax hikes than feared. And really now markets are pricing around a 90% plus chance of a Bank of England rate cut um, next week. It's not next week, actually, it's the week after. I think it's the 16th um, of December, I think. Um, yeah, but really, so short term, okay, but the long term structural issues haven't really changed. Lots of economists, they still see public finances stretched, long term realistic. Really, then we're looking at sort of sterling in the longer term, UK gilts in the longer term are potentially vulnerable. Um, Does help the Bank of England cut rates, though. As I said, pretty much nailed on now for that Bank of England meeting in a couple of weeks' time. But as I said, bigger economic challenges probably still in play, with questions over spending plans and certainly those backloaded tax rises, which will impact a lot of people further out. For cable, though, you can just see we did jump up out of this. Uh, Mile bear channel, really, series of lower lows, lower highs. That downward trend line as well, broken out through that. I sort of pitched a sort of double bottom potentially, and a rise to 134. We're just consolidating actually around 132.50 or so. We have got the blue line, which is the 50-day crossing down below the black line, the 200-day moving average. So that's a death cross, so a bearish signal, but sometimes it does lag. So interesting that whether this is just bullish consolidation before a move up through those simple moving averages to possibly 134 or so. Otherwise, support is probably back around this bottom of this channel, bottom of this downward trend line, which is just above 131. We also had last week the RBNZ meeting, and was really a hawkish cut, really. So they cut rates by 25 basis points to 2.25%. And really was, as I say, pretty hawkish, really, in explaining their current and future action intentions. They admitted CPI has increased to the top of the 1 to 3% target range in Q3, but they also added, given spare capacity in the economy, it is expected to return to 2% by middle of next year. Economic activity was weak in the middle of this year, but the RBNZ does see it picking up, and lower interest rates are supporting household spending, and the labour market is now stabilising. Certainly, a weaker exchange rate has been supporting exporters' income. And the kicker really was in the bank's updated forecast, where policymakers now expect the rate at 2.2% in the first 3 quarters of next year. So that means the bar for further easing, further rate cuts looks now very high. And we've got a big jump in Kiwi, you can see there, on the Wednesday last week, and we're building on that now. Consecutive days of gains, 7 consecutive days of gains after these lows below 56. Long-term lows, actually, they were. If we go to the weekly chart, you can just see we hit levels that we haven't seen since, yeah, well, April of last year. So long-term lows really didn't get anywhere near the sort of 54.84 level. Not last year, sorry, that's in April. And the Liberation Day lows. Sorry. So yeah, those lows didn't get near those really. We got close to the low in well, end of March, start of April. But then the Liberation Day low is at 54.84. We got down to 55.77. Nice big bounce. Whether we're still in this downtrend that was from the high of this year at 61.20. Well, we're just trying to navigate the blue line, the 50-day moving average, and then this first major fib level. Actually, that's at 57.27. So just watch out for this area. A bit of consolidation potentially after a really strong move higher. Bulls then aiming for the halfway point of this move. That's at 58.02, and then you've got the 100-day moving average, the grey line at 58.20. Otherwise, if we move back down, then certainly minor fib level at 56.20, which sort of capped the downside pretty much over the last couple of weeks. Just quickly, then also we had Japanese CPI data last week that confirmed really a help to Ada's comments actually today that conditions are falling into place for the Bank of Japan to make a step or the next step in the process of policy normalization. Tokyo CPI, it's a forerunner really for the national data to be published very soon in a few weeks. It remained well above the BOJ's 2% inflation target. So headline inflation, that eased up actually. Sorry, 1/10, but still high at 2.7% from 2.8. Core measures, both ex fresh food and ex fresh food and energy, they were unchanged actually at 2.8%. And really then yeah, all of this data, the CPI data, really reinforced the potential for a rate hike coming soon. The weak level of the yen as well might become an even bigger factor in the BOJ's assessment. But aside from that data as well, we had activity indicators which showed resilience, October production growth, and retail sales substantially beating expectations in Japan. So, as I said, pretty high chance now of a rate hike on the December 19 meeting. And we've shown you dollar yen already moving down lower towards 155 now. And that is the dollar yen chart there. Very quickly, finally, as well, Aussie data we had last week that was the CPI October data that rose actually from 3.6 to 3.8%. Pretty strong, hot report actually. Largest contributor being housing, followed by food and non-alcoholic beverages, both rising 3.2%. Underlying inflation as well, that accelerated actually from 3.2 to 3.3, so above the RBA's band, actually, the 2 to 3% band, and it really left that data with the RBA no room to cut the policy rate any further, really. And markets are now even pondering, I think, a possible rate hike towards the end of next year. We got a big jump, as you can see, in Aussie dollar. Finally, it's still pretty range bound, but at least the 200-day moving average, the black line, held as support, 64.63 that is, and we're now just above those 50-day and 100-day moving averages, so potentially getting up to the top of this band, 66 and then 67. The bulls will certainly be aiming for after, well, 7 straight days of gains in the Aussie. Okay, moving on then to this week's main events. Not too much, really, just some US data that we're all catching up upon, obviously. So we have ISM data out today shortly, as well as Wednesday, and then inflation figures out on Friday, as well as the Eurozone inflation figure as well. First up then is ISM manufacturing data, which, well, for comparison, actually, the PMI data that fell to a 4-month low of 51.9, and the output index that fell to a 2-month low as well. So yes, might be a touch softer than the ISM manufacturing data, and people will be markets looking out for those input prices really, and services then as well. For comparison, services is out on Wednesday. Sorry, headline seen in the PMI data rose to 55 actually, so a 4-month high for services. And also had the strongest output gain since July. Business expectations, they also hit an 11-month high, supported by reduced political concerns, of course, and the end of the government shutdown. So, may help services, but manufacturing touch softer in the ISM data. And then we do have the core PCE figures, Fed's favored inflation gauge, of course, broader measure of inflation rather than CPI. Just for your guide, if you remember CPI, September data, that showed headline at 0.3%. So a touch lower than the expected zero point 0.4, and the core remain well increased at zero point 0.2, expected zero point 0.3. And then September PPI, these two figures feed into then the PCE. That rose zero point 0.3, pretty much as expected, and lifted the annual rate to 2.7, which was also expected. So when we feed those elements into PCE, then we will get probably an inline figure around 0.2%. I think core PCE is expected. So nothing really to write home about. I think the issue is, and if you just bear with me, because I'll just pull up the odds for the Fed rate cut bets. Just bear with me a sec while I just grab those. Um, and I haven't looked at this recently just because the odds have been, well, they've been interesting, but certainly this is a page that we used to show you quite a lot. So bear with me one second. It's the CME Group Fed Watch Tool, very, very widely watched page. This is, it's a free tool. So bear with me one second. Um, And if you don't have access to Bloomberg, which many of us don't, then this is a great tool. It's basically the CME Group is the biggest futures exchange in the world, and these figures they basically analyze the probability really of the FOMC rate moves for upcoming meetings. So this is for the 10th of December meeting next week, and it bases prices off the December contract essentially. But it's using basically 30-day Fed funds futures, really, which have long been relied on really to express markets' views, of course, on the likelihood of changes in US monetary policy. So it's a really great tool because you can visualize really both current and historical probabilities of various FOMC rate decisions, really, and changes and outcomes for a given meeting date. So if we look on the 28th of Jan meeting, for example, then you can see the current rate is 3.25 to 4. We get a definite cut already. That's priced in. But then another cut, really not that only 20% chance of another cut if we do go, say, in December next week. And for your guide, then December, you can see there's an 87% chance now of a rate cut. So that would be moving from the current rate, 3.25 to 4, down to 3.5 to 3.75. And what is interesting when we get to, say, October, you can kind of see the terminal rate, which is around 3% there. And you can just see the odds then if we were to move lower below that, or the odds are higher of staying around that 3% mark or so, 3 to 3.25, that is. So we're above sort of around 56% or so. Chances are that of that happening, and sort of 44 just below that, if we do see a terminal rate, the end rate, if you like, being below 3%. Okay, that's the CME Fed Watch tool, which I haven't shown you for a while. So really useful piece of, just really useful internet page, essentially. But as relates to all the data this week, especially, you kind of see after such a big chance that markets are giving 87% or so, we would really need huge hawkish data really to shift the dial of that 88% chance of another rate cut moving really below to anything questioning that rate cut. I should say on Wednesday we do get ADP payrolls data, and potentially that could be zero or negative. Consensus, I think, is for 10,000. And potentially then, as I say, clear risks of a negative read. And then we get Thursday's Challenger job cuts data, which could also send dovish signals, actually. So It's interesting, really, considering the dollar hasn't really fully absorbed the negatives of the recent dovish repricing, if you like. We're only now just rolling over, as I showed you. Then potentially the risks are for the downside to the dollar this week as markets basically cement that rate cut expectation. As I said as well, President Trump potentially going to announce the next Fed chair in the next few weeks, even the next few days as well. And if it's Hassett, then as I said, he's a dovish kind of guy. So yeah, just watch that and the dollar implications. Finally, let's just get to where are we? Eurozone CPI data. And I just pull up the Eurodollar chart, which we haven't looked at just yet, which is here. So you can just see we're moving higher now with this dollar weakness. Eurozone CPI data we get on Tuesday finally. Inflation environment pretty steady in the Eurozone, and so is policy, really. We've said this for a number of weeks now. Um, There are some outside drivers like producer prices, of course, a strong euro relatively could provide some downward pressure on inflation, while domestic drivers, especially in services inflation, probably keep inflation risks balanced in the short run. As I said, Tuesday, then we get the November release and possible tick down in the headline. That came in at 2.1% in October, while core and super core were above consensus and services lifted to 3.4, previously 3.2. Otherwise, though, has to be said, inflation likely to remain close to that 2% target for the coming months, really. And that really doesn't provide any reason for any rate change by the ECB. You can just see then euro dollar just picking up above the blue line and the grey line potentially. That's a 50-day and 100-day moving average at 116.16, 116.43. If we get above there, then we've got the halfway point of this near-term sort of summer move, if you like. 116.55 is the halfway point, and then the next fib level 117.17. If we do lose, probably the low. Um, if we do lose, yeah, just support around this sort of below 116, then we've got major support. You can see around 115.04, just above 115. Okay, I am going to wrap it up there. 39 minutes or so. So really do appreciate you being all on the call for so long. And yeah, lots of you tuning in actually. So really good support. Really do appreciate it. Um, yeah, please do let's just follow us on social media. Lots of different channels. And also, I would say we put up a daily commentary on the website after the US close, just looking at US assets, stock markets, look at the day ahead as well, the major currencies, and a chart of the day as well. Thanks so much for being with us, and we will speak to you the same time next week.